Recording. Hi, good afternoon. Let us discuss today on cash flow statement. Cash flow statement is also called as statement of cash flows. Statement of cash flows. The statement is to be prepared actually after the preparation of all other statements. All other statements include all other statements include here. Uh, uh, it is to be prepared after the preparation of income statement, retained earnings statement, and statement of financial position. Without these statements, you cannot prepare cash flow statement. Okay. So first of all, to prepare cash flow statement, you must prepare these three statements because the outcome of those statements only will be used in the cash flow statement. Why do we prepare cash flow statement? Because because cash flow statement tells us that where did cash come from and where did cash go, whereas our income statement doesn't tell us, because the income statement is prepared based on accrual system. Accrual system means the incomes, whether you receive or not, for a particular year are recorded as incomes. At the same time, expenses which are shown in the income statement might have been already paid or still payable. That's called an accrual system. Accrual system doesn't consider whether the expenses are really paid or not. Expenses of that particular period are considered irrespective of the payment. The same way, incomes are considered in the income statement irrespective whether they received or not. So current year incomes minus current year expenses will give you net income. Current year incomes, whether received or not, current year expenses, whether paid or not, will give you income statement. That is the reason why your income statement outcome, that is net income, is different from your cash balance, because you consider lots of expenses in the income statement in which you will have some expenses paid in cash, some expenses not paid in cash. Say for example, depreciation. Depreciation, you show it's an expense, but in actual there is no payment. It is reducing your net profit, but there is no cash payment. Loss on sale of assets, discount on issue of shares, right? So likewise, you have lots of expenses and incomes on which you have not paid or not received, still considered in your income statement. Therefore, your cash balance will be different from the income which is showing in the income statement. So we need to prepare cash flow statement. Cash flow statement. Cash flow statement tells us where did cash come from and where did cash go. So you will have answers for these two questions, whereas you can't find these answers in the income statement. Using cash flow statement, you can find the answers for these two questions: where did cash come from and where did cash go. A cash flow statement can be prepared in two methods. One, direct method; two, indirect method. For CMA syllabus, you should consider always indirect method. So please remember, in indirect method is tested in CMA examination, not direct method. But we'll learn both starting with indirect method. Okay. So let us prepare a cash flow statement using indirect method. When you prepare any statement, first of all, you need to give the details of your company, etc. Company, my company limited, statement of cash flows, statement of cash flows as on 31st December. So you will have three headings here. One, cash flows from operating activities. Cash flows from operating activities. These amounts are the real cash flows which you received from the core operations of business based on the nature of your business. Say, for example, you are into selling of electronic goods. What amount of cash you generated by selling of your electronic goods? So, you take net income as a base, net income as per income statement, that is profit and loss account. Take the amount here, add non-cash items, non-cash expenses and losses. Non-cash expenses and losses should be added, including depreciation, amortization. Please remember all this. Amortization, okay. Loss on sale of assets, loss on sale of assets or investments. So these amounts are to be added here. Next, we will have discount on shares, bonds, written off. It should also be added. Next, interest expense should be added here. So these non-cash expenses, non-operating expenses are to be added back. This amount is to be added back, less non-cash, non-operating incomes or gains. Incomes or gains, you can say. Okay, which include gain on sale of assets or investments. Next, premium on issue of shares, premium on shares or bonds written off. Yeah. Next, any interest income should be deducted. Interest income should be deducted. So these amounts are to be deducted. Okay, I will write in brackets, means it's a minus item. All right, and you will have add items, decrease in current assets and increase in current liabilities. Please remember, increase in current liabilities should be added. Decrease in current assets, increase in current liabilities should be added. I'll explain you in detail. Less increase in current asset, decrease in current liabilities should be deducted. Clear? So here, as I added all these points, like these are all non-cash expenses which I debited to my income statement, which reduced my net income. So I'm adding them back. At the same time, we considered all these amounts as a gains, but in actual there is no cash in. Therefore, because it increased my net income, I'm reducing it. Now, what are these two items? Decrease in current assets, increase in current liabilities, etc. For this, let me give you a T balance sheet here. T balance sheet. This is a balance sheet, asset side, and liabilities and equity. Now you have current assets, fixed assets. Here, liability side, you have current liabilities, long-term liabilities, shareholders' equity. This is a total. Okay. And here, this is a total. Clear. When you say decrease in current assets, here decrease in current assets, say for example, accounts receivable. Accounts receivable at the beginning was 25,000, means our customer balances. Now it is 20,000. What happened? Today in the morning, 25,000 was a due from accounts receivable. Now in the evening, only 20,000 is a due, which means we collected $5,000. It's an inflow. We are adding inflows and deducting outflows. So this is an inflow, it should be added back. That is decrease in current assets. Decrease in current assets. As I told you, CMAIP is the acronym of current assets. So in all the current assets, whatever the current asset decreases, it should be added back because it is fetching you cash. It is bringing you cash. So this current assets and current liabilities should go to operating activity. I'm writing here for you that it goes to operating activity. OA, I will write OA. Means in the balance sheet, current assets and current liabilities are to be adjusted in operating activities. Okay, balance sheet items. Alright. And increase in current liabilities. For this, I'll give you one example. Say bank OD. Bank OD means we borrowed money short term from a bank. Bank OD. Now we are discussing about current liability. I had an overdraft of 12,000 with a bank. Now it is 20,000. Means I had like a month back, a quarter back, 6 months back, I had 12,000. But now it is 20,000. Means between this period I borrowed another $8,000 so that the bank overdraft has increased from 12,000 to 20,000. So there is a cash inflow of 8,000. That's the reason why my liability went up. Okay. So what you need to do is decrease in current assets should be added. Increase in current liabilities should also be added. Now let us concentrate on here. Increase in current assets, decrease in current liabilities should be deducted. Let me explain you why increase in current assets should be decreased. Say for example, current asset, inventory. Inventory, you have 12,000, now it is 20,000. Means you purchased an inventory of $8,000 and you paid cash. Inventory is a current asset which was 12,000. Now the inventory value is 20,000 with you. How it increased? Because you purchased. When you purchase inventory in stock items, you pay cash. So increase in current asset will decrease your cash balance. Therefore, it is an outflow. Outflow means cash goes out of your business. Decrease in current liabilities. Decrease in current liabilities means you have a short term loan or accounts payable, your sundry creditors, accounts payable. 10,000 was the due in the beginning. Now it is only 7,000. You have to pay somebody 10,000. Now today it is only 7,000. Means you paid 3,000. There is an outflow of $3,000. So please remember, decrease in current assets should be added, increase in current liabilities should be added, increase in current assets and decrease in current liabilities should be deducted. And whenever you have a doubt, please check these examples once again. Okay, so add all these amounts combined here to add this item to get. So when you add these amounts to your net income on the top, this amount, you will get cash flows from operating activities. Okay, so cash flows from operating activities will get here. This is the amount. This is the amount you will get from operating activities. So in operating activities only, you have to be very careful because you have lots of items here. Two add item section and two less item sections. Okay. Now let us discuss on the cash flows from investing activities. When you are discussing about cash flows from investing activities, please look at the asset side of your balance sheet. That is fixed asset side of your balance sheet. Now current assets and current liabilities we have already taken in. We have already taken in operating activities section. This is gone. Okay, now left with you is fixed assets on the asset side. This has to be considered in investing activities. So let me take you there. What all the items come under investing activities? So cash flows from investing activities. Okay, cash flows from investing activities will give you this. Cash flows from operating activities. Now let's see. Simple. Inflows decrease, otherwise I will write decrease, otherwise I'll write like this, decrease in fixed assets and investments. Means I just write it for you, sale of fixed assets or investments. That is an inflow, that is an inflow. And outflows will be the other way, that's it. Outflow, increase in fixed assets, increase in fixed assets, increase in fixed assets and investments because we are buying it. Otherwise we can say purchase of fixed assets and investments. So easy. If an asset is purchased, obviously cash goes out, therefore it becomes outflow. So total of inflows minus total of outflows will give you cash flows from investing activities. Investing activities. Okay, this is A, this is B. Okay, so far we received A and we received B. We have one more activity that is called financing activity, which are covered here, these two. Okay, financing activity, these two will go into financing activity, FA. Financing activity, so simple. What you need to do is You have to find out the other areas, that is shareholders equity area. Okay, and long term debt as well. Financing activities. Financing activities. So you have long-term loans, shareholders equity. There are inflows, there are outflows. What are the inflows? Let me tell you. Inflows are borrowings. When you borrow money from the banks, borrowings, issue of shares or bonds. Okay, borrowings, issue of shares and bonds are inflows. Then outflows will be when you borrow, you will repay the amount sometimes. Repayment of borrowings means when you borrow the loans in next year or 2 years, then you may repay them. Next, redemption of bonds, shares. When you repay your bonds, that will also take money out. Repayment of borrowings, redemption of bonds and shares. Then treasury stock. Remember, treasury stock. Treasury stock means our own shares we are buying back. So obviously cash goes out. So simple. You should just think that whether the cash is coming in or going out. Okay. And payment of dividend to our company shareholders. Okay. To shareholders. Our company is paying dividend to our company shareholders. That should also be deducted. So these two amounts are in and these four amounts are out. You may have less than this, but maximum points will be this much. So take this amount outside, you will get cash flows from financing activities. Financing activities. Okay, so you have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Then add all the three, you will get increase or decrease in cash during the year. During the year, this is the amount of the total of A plus B plus C. A plus B plus C. So you have increase or decrease in cash flow during the year. The total of all the three headings A, B and C. A plus B plus C. Okay. Then add your opening balance of cash, beginning balance of cash and bank. You will get ending balance. Ending balance. Cash and bank. And remember, this amount you are going to find in your balance sheet. In your balance sheet, this is the amount you will find. This amount is to be exactly match with your balance sheet item CMAIP. Remember CMAIP, this item, cash and bank balances. So it should match with this amount. Okay. Anyway, you are not going to prepare this way, but you should know the contents. This amount should match with balance sheet cash and bank balances. Cash and bank balances. While preparing the cash flow statement, you will have some non-cash transactions which need to be presented underneath the cash flow statement but not in the body of the cash flow statement. The examples are some non-cash transactions, transactions like purchase of buildings, buildings by giving, by issuing, I'll write, by issuing the company shares, our company shares. Okay, purchase of land with a mortgage loan, purchase of vehicles with a mortgage loan, etc., are to be shown under cash flow statement in footnotes, but not in the cash flow statement, but not in the cash flow statement. Very important point, please remember. So any non-cash transactions take place, like you are buying the buildings, but the owner of the building, we are giving our company shares. You are purchasing a land, but landowner, your landowner is getting the loan amount from the bank. Bank is directly paying to the landlord, but not to us. Our liability will increase, our asset will also increase with no cash inflow, no cash outflow. Of course, our loan amount will be paid later. When you pay loan amount from next year onwards, you will have repayment of borrowings. That is there. But now, when this transaction takes place on that day, you will not have any cash ins, cash outs. That's the reason why, please, all these transactions are to be recorded underneath the income statement or cash flow statement, but not anywhere in the body of the cash flow statement. Remember, they are not to be taken any place in the cash flow statement under any section. We have three sections: operating activities section, investing section, and financing activities section. So nowhere they are to be recorded. They are to be recorded only in the notes. Please take it a very important point. Yeah, while preparing cash flow statement, you prepare cash flows using cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. But some activities which will increase your assets and liabilities with no cash inflows and no cash outflows, therefore, they are to be mentioned only in notes, but nowhere else.